Companies Act, a special presentation by The Firm.
Last week on Companies Act, we examined the various schemes permitted under Chapter 15. Plain vanilla schemes, CDR schemes, schemes to buy back shares, merger of a listed company into an unlisted company, fast-track mergers, demergers, and cross-border mergers. This week, we examine the various approvals a scheme needs and shareholder buyouts. Just like the 1956 Act, the 2013 Act 2 requires a scheme to be approved by a majority of creditors or members representing 3/4 in value. But the 2013 Act sets two new standards for scheme sanction: that it must be in conformity with accounting standards, as SEBI has already specified for listed companies, and that notice must be given to the government, Income Tax Department, RBI, SEBI, stock exchanges, official liquidator, CCI, and all other concerned regulators. They have 30 days to make their representations.
First of all, it was not a requirement under the Companies Act earlier on.
No, it wasn't.
Based on experience, MC had come out with the guidelines that you please give the notice to everybody. So the new provision is in line with the guidelines they have issued under the 1956 Act.
Especially because the tax department was having a lot of trouble with many of these
schemes. Tax also and sectoral regulation also, because they have said, you know, first merger will go through, then you come to me. Now, hopefully, I am only hoping it will work very beautifully if no sectoral regulation for that matter will go back after the merger is saying, no, I want to look at a fresh. Then there is a problem because still moving in circles. So I am only hoping that those regulators or connected bodies, whatever viewpoint they have on a given transaction, they will place before the tribunal. And after consideration of all those factors, tribunal will pass a final order. So we have a certainty in terms of time and whether the transaction is going through or not.
Right.
But if everybody is going to take a view, I have filed my objection limited for merger, but I have to apply my law again when you come back to me after the merger is happening, then the problem is not solved, it is compounded.
There might be a jurisdictional issue as well there, because let's take, in a particular sectoral issue, this tribunal may not be competent to rule on a regulatory issue. For example, let's take a telecom license. Now, whether a telecom license is capable of transfer or not, if this tribunal rules that yes, it's capable of transfer. But under the telecom regulatory or regulations, you have a different tribunal who actually needs to decide as to whether a telecom license is transferable or not. So just as an example,
would happen then?
I'll just put it slightly differently. I think it is in the interest of the parties who are going through this process to get all their approvals. Absolutely necessary. Therefore, most schemes, and I would think, when I say most, I would even go to the extent of 100% of the schemes, say that the scheme is conditional upon the following approvals. And if it's a telecom company, they will talk about, the telecom regulator's approval as part of the scheme. So even if the tribunal clears it, the scheme is not through till you get the last of those approvals, because it becomes effective only when you get the last of the approvals.
I think what this provision does is not a single window clearance under all laws possible, because this tribunal doesn't have the jurisdiction to do that. But what it does do is, if there is any abuse where certain provisions are hidden, and under the garb of a sanctioned scheme, you then go to a telecom regulator to say court has sanctioned or tribunal has sanctioned a scheme. So even though not allowed under your regulations, look at this court order or tribunal's order, you are bound by it. I don't, and that was in one way being misused or abused.
It was happening,
It was happening. And for example, tax is a perfect example where schemes provided for just anything. And then you went to the tax authorities and said, look at my scheme, it has court authority, so you can't question it. So that abuse will stop. But I don't think this will be single window clearance.
No, it is not, but it facilitates the task of getting subsequent approval faster.
That's true.
That's the point we are looking forward to, rather than Dino. But
so I have a question, slightly naive it may seem, but from what I've understood of how currently the court system works on schemes, is that they don't really question your scheme beyond a point, right? If you have the requisite shareholder approval, courts are supposed to allow for the scheme. They're not supposed to impose their commercial wisdom or their regulatory wisdom on your scheme, right? So I'm just curious as to how tribunals, which will be a slightly different body than our current court system, are going to be able to deal with this, given that they now will have to address objections being raised by specific regulators in their forum, not in a separate forum. It is not the TRAI raising it at the TRAI level or the TDSAT level. It's the TRAI now sending a representation to the tribunal saying, look, this is my problem with the scheme. What is the tribunal going to say? Tell the company that go sort it out with TRAI, get a no objection certificate, only then will I pass the scheme?
I think the way it should really work, and which will be objective, is that unless the tribunal sees fraud or a violation of law, and it should not sanction a scheme, even if it's another law, not just the Companies Act. Other than that, the tribunal should sanction schemes and leave it to those regulators, even if they've objected here, to decide
but
whether or not.
But then what is the purpose of this section, sir?
The purpose is that the tribunal gets notice.
As I said, if there is a violation of law and somebody says this violates this regulation, then the tribunal will take notice of it.
Whether it's a bona fide scheme at all, whether the tribunal should at all sanction this scheme, or it should sanction the scheme and let the regulator decide, the sectoral regulator.
Well, I suppose that's good news for the tax department. Now on to treasury stock, or rather the ban on it. The 1956 Act disallowed a company from holding its own shares, but companies circumvented this by holding shares via trusts. The 2013 Act disallows a company from holding any shares in its own name or in the name of any trust. This casts a cloud on existing treasury stock and future scheme structures.
Yes, one more option of structuring, or the fact that companies could hold through treasury their own shares, will go away.
Yeah.
But if it's known in advance and that's the law, it again gives you notice in advance that this is not going to be allowed, and you plan. So yes, shares will be cancelled or they'll be transferred out as part of the scheme, and there could be several options what could explore.
So you don't see this serving as a big hurdle in being able to design schemes?
No, I don't think so.
Not at all?
I mean, yes, some options are closed, but in one way, again, one bad apple, and our legislators are compelled because of maybe one bad apple to legislate and stop many other good schemes providing for the same thing.
Okay, so illustration of one option that goes away from the table in a scheme because of this no treasury stock.
So, I mean, let's take a company and a subsidiary merging, or a company
as simple as that.
Simple as that. So, you have to cancel the shares or make sure you divest the shares as part of the scheme or prior to the scheme, rather than keep your shares and therefore keep controlling interest. Keep a low promoter interest, keep it through the company, and the two combined can keep you comfortable throughout life.
I think that seems to be the intent, that they don't want maybe promoters to have additional voting rights through treasury shares.
Which was the reason why the earlier Act also did not allow for this, and people were using trust structures,
correct.
right?
So, but they could have addressed...
trust structures were also being abused in some fashion.
So they could have addressed that by saying that make these shares non-voting, or have some restrictions, because
then somebody would have found another way through this. Right?
Yeah, but it does take away the flexibility.
No, once you have non-voting, then what you do? So let's say, for example,
what first, before we get to that, what flexibility does it take away for you to ask, therefore, that why couldn't they have made this non-voting?
It's just one way of managing capital management, right? I mean, companies can use those block of shares to raise capital at short notice in a very short time frame.
Could it not then lead to instances of insider trading of any sort?
I have a very different perspective on the insider trading.
Okay.
Because if you see any scheme and any treasury stock through the trust, the beneficiary is the merging company. Okay, so what insider trading are we talking about? First and foremost, because it's the company which is making the money, so it is belonging to all the shareholders. It's not belonging to a promoter, shareholder, or anybody else. The abuse is not on the cash flow side. The abuse is on the voting right side, if at all. And that is what they needed to plug. I'll tell you what, this to my mind takes away a lot of flexibility.
Okay, tell us why.
I'll tell you what, if let's say I am a company which is buying shares of another company, similar business, let's say just taking examples at 500 crores. So it becomes my wholly owned subsidiary when I buy those shares. I want to now get the synergies of the two business, so I want to put it in one company, because then it helps me to get the synergies. My accounting standards prohibit me to do a fair value accounting when I am merging a subsidiary into myself. I have to do book value accounting. When I am buying shares, I have recorded it at 500 crores. Let's say the net asset value of that company, which book value is 200 crores. I have a huge goodwill of 300 crores in my balance sheet. and my accounting standard further requires me to write it off over a 5-year period or maybe a 10-year period, depending if I can convince the auditors. A 60 crore hit or a 30 crore hit, I mean, is not something that I would want to do. So either if they want to stop this, they should have also allowed the accounting standard to change, that I can do a fair value accounting in such scenarios. You know, it's just going halfway and then, you know, hitting me. So to my mind, it takes up a lot of flexibility, and, you know, I will think when I'm doing an acquisition that is there, if I have to take all the synergy benefits, is there a hit on me or not? And that's very important.
I think the implication of this and whether it is going to impact the business operation, like Amrish is saying, has not been evaluated completely. You know, world over, this is being encouraged. It reduces cost by the way of raising capital from the market. You have it in stock, you give it to them. So it has a number of advantages. Right. If you can plug the loopholes, it gives humongous amount of flexibility to the businesses.
Companies Act, a special presentation by The Firm.
Special shareholder exits, high governance standards, and majority of minority voting in related party transactions. In many places, the 2013 Act bats for minority shareholders. But Chapter 15 has thrown up a surprise. Earlier, any shareholder could object to a scheme in a court. Now he will need at least 10% to do so. Rarely does even a large investor like LIC own that much stock in a company. It seems very, very unfair, but Mr. Gupta, I'm sure companies are celebrating because, you know, all those hold-ups and schemes will go away.
You need to strike a balance from abuse to proper use.
Yeah, and this this has gone to another extreme. You would agree?
I won't say. I won't say that.
You look at the current provisions or erstwhile provisions. You know, if a minority wanted to object under a 397, you know, which was the minority objection provision, again, any promoter or any this thing, it was a 10% requirement. They will just maintain that.
But that is for mismanagement and oppression.
So, it's the same thing here. You are going to not want to.
Look, if you want to accuse the company or its management of mismanagement and oppression, I can understand you need that high a threshold. I can't understand if you are a dissenting shareholder, why you need such a high threshold to dissent.
Yeah, because, you know, the way it was happening is that people were coming and just putting roadblocks to the schemes, and, you know, they were just being dragged on. No, and then if you see most of the court decisions on this till now.
I would completely agree. No, I would completely agree that this is
a corporate India.
Corporate India. Because I would say, let's look at, if you're selling a business, you need a special resolution. If you have mismanagement, there's a 10% threshold. For schemes, what is so special that you need to have anything more liberal? Given all of the abuse, I had a case where there was a shareholder holding one share who held up a public company merger for 1 year.
And that must be bought after the board meeting for the merger. I can assure you that.
I'm making another perspective to just to say that it is not unfair to minority. For instance, number one in the scheme, as Haigreve touched upon it, it is not within a related party transaction. The management is expected to know that it is largely in the interest of the company and shareholders. Majority of them will get it approved in the general meeting. And now, therefore, for someone to come, unless it's a very serious objection and impact it significantly, why should one be heard? I mean, I'm just asking, because you are taking 90% for ransom.
No, and related party can't vote. Let's also look at the fact that where there is abuse has been checked.
By SEBI already.
No, SEBI and the SAB. This Act also does it in 188, right? So, okay, I've been outvoted on this table.
No, I think the point is...
no, there are enough of counterbalances is what we are saying. And I don't think, you know, it is not, it is balanced. If you see the voting pattern, if you see, why I'm just laboring it is, if you see the voting pattern that happens in a tribunal convened meeting, it is not only value, it is also majority in numbers. So if they are so this thing in the majority numbers, you know, the promoter will not have that majority number in that sense. He will have value obviously, but not majority numbers.
By the way, Section 237E empowers a tribunal to order that shareholders dissenting to a scheme be provided an exit.
Which is directly linked to the previous point that you have, the why 10%. This is an option. Right. Tribunal will say, okay, I'm not hearing you, but I may provide for exit.
Yeah. Okay, so how is this exit going to work?
So I think, you know, I mean, let's take a 1% shareholder or a nominal shareholder who doesn't have the right to stop the scheme. but who's dissenting and who says that, look, if this scheme is implemented or this restructuring is done, I don't want to continue as a shareholder. And let's also assume that, there is no market for these shares. So he can come to the tribunal and say, why don't you provide for my exit, do a fair valuation. I'm not sure that I'll get a value outside of the scheme or if I remain, and give me an exit. So I think even under our 56 Act, this was always there. The power was there, but it is now explicit.
And now for the squeeze out that isn't really a squeeze out. Section 235 of the 2013 Act, similar to Section 395 in the 1956 Act, gives companies the power to acquire shares of dissenting shareholders. That's if the scheme has received approval from shareholders holding 90% of the shares. But Section 236 is a new provision. It provides for an acquirer with 90% shareholding to offer to buy out the minority, but it does not explicitly compel the minority to sell, falling short of a true and proper squeeze-out provision. Can you explain to me what the provisions sort of imply?
I'm not sure that I understand it.
I'm in good company then. Because it's very confusing actually. 235 is very confusing.
235 is really akin to our 395 as we have in today's statute. Hasn't really been used, but it's just an enabling provision where a scheme can also provide for buyout of shareholders. But how it hasn't been used, how it will be used, what was the intent, and there seem to be more drafting errors, there appears to be, as to what the real intent.
So not used very often in the earlier avatar?
Not used very often in the earlier avatar.
Why is that so?
Because I really think that there was no clarity as to how and when it ought to be used. Whether it was a squeeze out, whether it was a buyout provision, whether it was dissenting shareholders, because of that lack of clarity, and that appears still prevails.
The ecosystem of the country did not allow delisting, by the way, even though there is enabling provision under the Companies Act and SEBI regulation for listed company. I think it did not simply favor delisting of shares. But these provisions are similar to many developed world countries where 90% and you can really, if you want, can squeeze out minority 10%.
I wouldn't really agree that we have that. Even when we come to 236, I don't think it's a squeeze out provision. I think a lot of noise has been made that our new act now gives us a squeeze out right. But in fact, there's no squeeze out right at all. What I think it does is that the minority who's stuck in that 10% can have the right for exit.
So that's still 236, and that's still easier to understand.
That's right.
What are the mechanics of 235? If 9/10 of them approve, you can buy out their shares? Is that what this means?
But not on a compulsory basis. That seems to be still lacking under the section.
Okay. Even 236 then, if we were to get there, is not on a compulsory basis.
Yeah. But it compels the minority having reached 90 to give an exit to the
majority.
To the majority.
But it doesn't compel the minority to submit its shares. So you could reach 98 and you still have 2% shareholders, floating around in the system somewhere, to whom you have to then send all your, sort of.
But when there is no liquidity, by the way, unless you really want to create nuisance.
So I'll introduce you to about 80,000 Cadbury shareholders.
I know.
I think
they're still waiting for a higher valuation in the Bombay High Court, sir.
Therefore, all I'm saying, unless you want to create a nuisance.
The point is, if it doesn't compel the minority to submit their shares, once the majority has acquired 90%, then this is not really a squeeze out, is it?
It extends the provisions of the delisting guidelines to even private companies, because under the delisting guidelines, we have to provide a 1-year window after delisting to the shareholders who are left behind. They can tender their shares at the same price. So now they're effectively extending that to even other situations where you reach 90%.
But to be honest, the present provisions are worse than the provisions today. Today's 391, 394, 395 have in a way been used for squeeze out, and there are several judgments where courts have held that how you can do a squeeze out. Let's say with majority not voting, promoter not voting, interested parties or parties which are being dealt with differently not voting. But today with 235 and 236, the question will be whether a scheme or compromise can actually do a squeeze out or not. Because given this ambiguity, are we worse off or better?
So the only squeeze out I've seen is that selective reduction of capital. That seems to be the most effective squeeze out that people have deployed in this country.
I think, you know, many of those schemes and the creativity there, whatever was created, I think are less likely to survive, you know, once this new act comes in.
All right. So there is no complete squeeze out. It's a partial squeeze out, but it doesn't seem to bother all of you that much. It would have been nice if it was a complete squeeze out.
We have been living with this probably, and it is continuing.
All right. So we come now to the wrap-up questions. Are we better off or worse off?
So I think the critical thing for us is to see how the tribunal pans out on all of this. And why I say that is that if you look at the 1956 Act and the court order, and if you look at implementing the scheme thereafter, there used to be a lot of ease. So when I say ease is, let's say I go to a water department to change my water connection, it will be very easy because of court order. I don't know the same efficacy will lie with a tribunal order.
So whether it will carry the same weight or not.
Yeah, because you know, tribunal order is a tribunal order at the end of the day. And did they have to provide for something which would have given it, you know, a sort of a court sanction, like we have in the arbitration decrees, you know, which ultimately goes to the court for, you know, it's what we call the final sanction. I think that would have helped in the practical implementation of all these schemes, and I think that's going to be the critical element. The second, I think, important thing is that whether the tribunal order can now look at retrospective appointed dates, which we are used to in corporate restructuring, is going to be a question, because courts had an inherent power to do anything that they want. Yeah. Okay. Whether a tribunal will have that is going to be, and therefore it will, I mean, the jury is still not out on this whether they have or not. That will challenge all your structuring. That one will want to look at. I think these are the two things that I see as you know, things that they need to work on and, you know, change it.
Harish?
No, I think it's a forward-looking act. I don't think people are going to be materially worse off. I mean, if you look at cross-border mergers, you look at fast-track mergers. I mean, the last act had a life of 57 years, right? And this is you can call it enabling provision today, but when you think of it, maybe 10 years down the line, when indeed Indian M&A is more aligned with global M&A, I think you created something that can facilitate.
So you're delighted with all the
enabling
that this act is laid out.
I don't see us being at least worse off. Is my overall take when I just look at this particular.
What chapter. A relief! At least we're not worse off. Mr. Gupta.
It has a lot of positives, as I read. For instance, for industry as a whole, uniformity, standardization, tribunal would know what the powers they have. I think, you know, a lot of haziness is cleared, but of course the emotional issue of tribunal versus high court will remain.
Okay, I've saved my best question for the last, Haigreve, to you, which is that if you had the power to decide whether M&A continues under the jurisdiction of the earlier act, which is 391 to 394, or it has to now exist under 230 to 236, what would you decide?
Honestly speaking, under the existing act, the 56 Act,
you would decide.
I would decide that, and I think that we didn't deserve an act in today's day and age with so many inconsistencies, with so many errors, and as professionals in the community, all our time is going in interpreting what these inconsistencies are, what the power is. We didn't deserve this. Corporate India has been crying about squeeze out. And the government says I have a squeeze out provision, and what comes is an exit provision. I mean, that's very disappointing.
Next week on Companies Act, the contentious Section 188, related party transactions.
Companies Act, a special presentation by The Firm.